Hi friends, good evening. This is Madhu Reddy from Money Breeder. Today I am going to discuss about the straddle. Okay, there are 4-5 flavors of straddles which I use for trading index, stocks, uh, Nifty and Bank Nifty. Okay, so how I trade, which scenario, which kind of straddle I am going to use. Okay, all those things I am going to explain. Since this is the recorded video, I am not having much time to explain all the flavors of the straddles. So only one straddle today I am going to explain. Okay, before going into the straddle handling in the stocks, this is the standard disclaimer. I am not a SEBI registered analyst or advisor. Please do your own research. Okay, whatever I am going to discuss here, just it's my learnings and what I am doing in the markets. I am not motivating you to do the same, or I am not saying you follow me. Okay, this is just for the educational purpose. Whatever the learnings I am having, I would like to share with my friends. That is the motive behind making this video. Okay, coming to the straddles, right? Okay, the scenario where I trade in the stocks, usually, see the scenario what I am telling you is a stock moved drastically, okay, and then it is going to be the consolidation. It is taking pause for few days. Okay, so in this, right, there is no direction to trade. There is no proper direction to trade. Okay, now for example, in the month beginning of the month, stock started moving up. It reached to the 25%, above 15 to 25% in a 2 weeks time frame. That means 1 to 15th of the month. Expiry to second week or third week, mid of the third week, the stock ran up like 15 to 25%. Now, since there will be a hedge positions, so they will not allow you, they means institutions may not allow the stock to go up heavily, because there will be some short positions in the stock. If that goes extreme level, right, those guys may get the loss. So now what they will do, they will try to defend from this and try to make the pullback. This is the one scenario. Second scenario is, they might have the positions at a certain strike level, so they will try to bring the stock to that strike level and holding the stock in that range until the expiry. This is the second scenario. Third scenario will be like, okay, if they wanted to bring the stock to the certain strike, but still, okay, there will be some people with greedy or something like that. Okay, they wanted to take still even up. Okay, in that case, this is the scenario. What they do is, here there could be a big fight. These guys, whoever bought the stock to certain range of certain strike price, they will come and sell the aggressively and bring the price to down 2 to 5%. Okay, you have to find out this kind of stocks at the third week of the month. Third week of the month. Third week of the month, we have to find out this kind of stocks. Okay, now let us execute. Let us find. Okay, this is where the stock selection. What is the stock selection I was talking? A stock should move more than 15 to 25% first 3 weeks or first 2 weeks. Then it may go to the consolidation, and you understood that it is as per your guess, it is going into the consolidation. Somebody came, try to push the price up immediately. So next, whoever brought from here to this strike price, they will come and aggressively sell the stocks to the down. Okay, that is where you need to keep this kind of overbought stocks in the watch list. Okay, This is the first criteria for the stock selection. Okay, then strike selection, I'll come to the strike selection later. Now the stock is reached to the position like this. Okay, trading in the range. Okay, now the problem is, let's say you are trying to trade in the stock here. Okay, the moment you take the position here, because it reaches to the support, you know that it is trading in the range, it is in the support. Once it reaches to support, our guess is most of the time, okay, it should reverse it. Okay, suppose you sold the PE here. The moment you sells, right, what happens at the support level is there could be some deviations. It comes here in here, because of the lot size, it will come and hit your stop loss, which is 3 to 5,000 rupees. Okay, hit the stop loss most of the time. At the same time, if you trade here, sell the CE call option, what happens? Immediately one candle it comes here, because of the stop losses, all the stop losses here, it is going to hit little up and take your stop loss. To avoid this kind of thing, what I use is I go for the straddle. The straddle, how I make is, okay, first here I won't trade here in the top. Okay, now I know that there is a stock is going to go up, but there are some institutional traders, they are trying to bring the stock. So I decided stock may not go beyond this. Okay, I am interested from here to here. If I take the position, naked position here, definitely my stop loss is going to hit 60% of the time. That was the experience I had, bad experience. Now I wanted to trade in the straddle. What I do is, most of the time, the basic idea is create the straddle here. Okay, sell the CE and PE here. Now wait for the market. Okay, even hold the position, overnight position also fine. Okay, so now what I will do is, because you are having the hedge, tomorrow even if the stock falls 4%, you will get minimal loss like 5 to 10,000 rupees only. Okay, that is just like one stop loss hitting your stock. Okay, so already it ran up, it may not go up. Okay, at the same time, with the strong bullish bias stock is there, so it may not come down as well because of the bullish bias. Okay, with some intention people got the stock to particular magic level, some logical level, so these guys will not allow to fall. At the same time, these guys won't allow to go up. Okay, now it is locked at the particular strike range. Okay, that is where you identify the stock. That is where you need the experience and your skill. Now what I will do is, I make the straddle here. Okay, wait for market to reach here. Once it reaches here, what I do is, the PE I see the 3 to 5k profit most of the time. Okay, then what I do is, I book this PE. Okay, this put option, I am going to book this put option. Okay, once I book this put option, now it is going to be the naked of call option. Okay, I will wait for some time. Okay, price to cross this based on the candle. If this breaks out and not coming down, what I will do is, this point again I will take the fresh PE. Okay, hedge for this thing. If the price is not going up and here it is trapped in the sense, I am seeing the price action pattern like shooting star. Okay, big red engulfing candle. Okay, if or morning star. Okay, or evening star in the sense, one candle, this is the red or green. Okay, above this it forms one shooting star. Okay, then it is going to be the engulf of entire thing. These three pattern, the moment I see it, right, what I do is, okay, I add one more call option. Now I am having two call option naked and this is my target. Okay, this is my target, or in between, average in between, this is my target. Once it comes here, I'll exit one CE here, I'll try to exit one CE here, and other CE I'll make here. So already I booked the profit of 5k or 3 to 5k in the put option. It went here, and extra naked sell options. Okay, if this comes right, loss in this is 0, and this is my profit under table. Okay, this is the logic I am going to use the in index or stocks or anywhere for the straddle. Okay, the strike selection, make sure that, let's say for example 4000 one stock is there, ADANIENT. Okay, it should be exactly at 4000, or it should be the strike CE and PE strikes should be almost equal, like 80. Okay, 81 to 79, not more than that. We are expecting here 3 to 5k, small amount only. Okay, if the deviation between this strike selection is more, 5 points, 10 points, wait to become both are equal. Okay, wait to become both are equal. Definitely at one particular price both should become equal. Until the time, don't execute. Okay, this is what. Now premium should match. Okay, now execution plan I already explained, like, okay, you take at the bottom, no need to put any stop loss here. Wait, if the market stay here only, no issues. If the market falls, your stop loss will not hit, you are having the hedge. Okay, even if it falls even down, you sell the additional call option, and once you get no loss no gain game, you exit both, because this is the mistake you have done here. Okay, you took the this direction, but it went against to you. What you have to do is, call option you will get the money, put option, okay, since it is sell side short straddle, even small fall also 0.5%, up to 0.5 to 1% fall, you won't see any loss here. Okay, still you will see the 1000 rupees profit only. If the short straddle you make, if the price falls, since it is the short positions, you will get the 1k 500 to 1k difference. Okay, so if it goes here, means long position. Okay, if it goes here, most of the time, because of this guys, right, it comes back and it takes the stop loss and goes down. Okay, that is where I don't want here. Okay, I wanted to be the short straddle. Here if I make, right, I need to go for the long. Okay, long straddle. If I make the long straddle, it may not worth for me most of the time. Okay, so if the stock stays there only, we won't get anything. In this case, if you make the short straddle, if the stock stays there only till the end of the day, you will see 2 to 3 points decay. Lot size is 250, for example. Okay, 2 points decay means 500. In this also 2 points decay, definitely you will see 500 to 500, minimum 1000 rupees you will get in this. Okay, this is the magic I wanted to use. Coming to the stock selection.